Good morning, students. Good morning, Miss Morris. So we shall just start by having a brief overview of what you can expect to be doing topic-wise during the course of this semester. We are now in week 1, which was from Monday the 18th till tomorrow the 22nd. So our first topic for this semester is going to be value-added tax, right? The abbreviation for that is VAT. We also know that VAT could mean it is a wine or a liquor container or a barrel. But this time, when we are in Financial Accounting 1, when we refer to VAT, we are not referring to a liquor barrel. We are referring to value-added tax. Okay. There's also a whiskey on the market, a Scotch whiskey called VAT 69. We're not referring to whiskey either. So value-added tax. So we're going to look at that today. Also next week, we are going to continue with it. Then the week after that, in fact, for 2 weeks after that, we are going to look at special journals and special ledgers. Now, what is meant by special journals and special ledgers, ladies and gents? You know from the first semester that we had a general journal where we had debits and credits. We had a general ledger where all our general ledger or T accounts appear in. But in certain instances, you find that certain transactions recur on a minute by minute or even second by second basis. So they happen continuously all the time. Perhaps you can just start for me 1 or 2 examples of transactions that will occur continuously all of the time. What is a typical transaction that you expect to occur like almost every second if you are, let's say, trading? Well, rent, not really, because your rent, even though you are continuously renting it, you are probably only going to be paying your rent once a month, right? Once a month. But sales, yes, sales, that's a very good example. Your sales, cash sales or credit sales, that is something that is going to occur on a continuous basis. So it will be senseless, or a point of sale transaction such as a sale, right? Or a purchase for that matter. Purchase is another example. Purchases, thank you, Awodwa. So ladies and gents, it's going to be too much effort really to do a general journal for each time that you have a sale. So you would rather have a very special kind of journal, which we call either our sales journal, or we can also call it our accounts receivable journal. That is the more modern term, where you simply record all your sales as they occur in one line. Because you know at the end of the day, or at the end of the week, or at the end of the month when you post it, the total of all of those sales transactions will be credited to the one and same account, namely our sales account, right? And we also know that the debits, if it's credit sales, if this is our accounts receivable journal, all the debits will go to one and the same account, namely our accounts receivable or debtors account, right? So that is a typical example of a special journal. But I don't want us to get ahead of ourselves. We're just illustrating what is coming up. You will have a same kind of journal for your accounts payable. In other words, where you record all your purchases on a continuous basis. After that, ladies and gents, we are going to look at reconciliations, and we are going to specifically focus on bank reconciliations and creditors reconciliations. Now, why do we need reconciliations? Very often, excuse me, the reason is pretty straightforward. It's because of timing differences. You may find that you close off your, let's say, your cash book on the 25th of the month, and the bank closes off their bank statement on the 28th of the month. So there are 3 days that do not correspond, and there might then be transactions that need to be recorded. Also, ladies and gentlemen, another example there is things like bank charges. The bank charges you'll only find out when you receive your bank statement or when you draw your bank statement from your bank's website. or if you have an overdraft, any interest that is payable on or that is due on your account or that has been debited to your account, or if you are in credit, if you've got a positive account balance, any interest that you may have earned, you'll only find that out from your bank statement, right? And the bank statement, like I said, nowadays you will just draw it down from the internet, so it's not mailed out like in the old days. Okay, so those are the three topics that we are going to do in term three. Then in the fourth term, the last term of this semester, we are going to look at property, plant, and equipment, which is quite a large topic. So we're going to spend quite a few weeks on that. And then the last, we will probably change these two around, and I'll tell you the reason for that, ladies and gentlemen. We'll probably do partnerships first because our class test in the fourth term is going to focus on partnerships. So we might do partnerships first. We'll discuss this, Ms. Morris and myself and Mr. Adams. Uh, and then maybe we'll do property, plant, and equipment last. And then we've allocated 2 weeks for revision, but that really is in case we do not have sufficient time in the 2 weeks for property, plant, and equipment, and the 2 weeks for partnerships. We might overrun a little bit in a fifth week, and then the last week, hopefully, we can actually do revision of our topics. Okay, so that is the plan and the planning for this second semester. Let me just check whether there are any questions from your side at this stage. Have you got any questions? You may ask it in person if you want, or you can type it in the chat. Miss Morris, I see you have a hand raised. You are most welcome.
Just a quick one, sir. The students must just be aware that I close the attendance register at 20 past, so they've got another 10 minutes just to complete it. Thank you, sir.
Thank you, Ms. Morris. Thank you, students. I hope you've heard that. By the way, I've also set the Blackboard where you can share attendance. It's not perfect. It's not perfect yet. That's why we still have got this manual register as well. So Blackboard is developing one. But anyway, I've already set it that way that if you are more than 20 minutes late, it marks you as absent, right? And if you are less than 67% of the time in the class, less than 67% of the total time you are present in class, it also marks you absent, right? So that is just a little bit of a incentive for you to make sure that you're on time and also that you remain for the whole duration, hopefully, right? But we don't want to force you. We want you to enjoy the classes. That is really our aim. We want you to be having fun while we are doing the classes, right? So that you actually want to be part of the class and remain part of the class. I hope that works. Okay, ladies and gents. Now, just a few things that I'd like to point out on our website. So I'm just going to display the website now. If you can just give me a second or two. Ms. Morris, you're welcome to come in anytime that you want. As usual, you are so welcome. So, ladies and gents, we are in the Wellington campus website, but all the websites for all the offerings are identical. We just maintain them separately, but it contains exactly the same items. So what I just want to point out here, ladies and gentlemen, as you know, our main working area is the content per topic. The content per topic. So if we scroll down, we've already done topic 1, 2, 3, 4, recording of transactions. So where we are now, we finished basic financial statements. There was a revision tutor class. So here we are now at topic 8, which is value added tax, right? So that folder is already available. Now I just want to change my setting here. I just want to change it to student view. Excuse me. Otherwise, it's going to look a little bit confusing to you. You'll see nothing changes here. It's still exactly what I displayed previously, but we've already loaded a few items here under topic 8 under that folder that isn't visible to you yet. So whatever you can see now you can see, I can see on my side and on your side. So here we have got the topic 8 learning outcomes. What are we expecting from you? Define value added tax. You'll see later on when I display a little slideshow, it also states that you must be able to define value added tax. Now, interestingly enough, your textbook doesn't actually define it. So, ladies and gentlemen, let me give you a little word of warning. You must also have a notebook or paper, or as well as pen or pencil ready. You will have to take a few notes during the course of this class, because we are going to define, we'll give you our own definition for value added tax. There are also a few things where we are going to be discussing value added tax beyond what is in your textbook or beyond what might be in any notes, right? So just keep something handy to be able to take down some notes. Then, ladies and gents, as you can see there, whichever edition of the textbook you are using, whether it's the 8th or the 7th, doesn't matter, you will find value added tax in chapter 10. Uh, there are some questions that we recommend that you go and do. We are also going to do some questions in class, not today. Today we are going to more look at the theory and the requirements of the Value Added Tax Act, but probably next week we are going to do some of the questions in class. I can copy three questions, three of the questions, the ones that we've decided on are questions, I think 10.5, 10.6, and 10.15, which I will then make available on Blackboard so that you can also display it as we do the questions. Then what we have done, we've divided this, as you can see, into 13 so-called little sub-chapters, this topic. So what we've already made available 2 weeks ago, just for those students who are very eager to get an early start, I hope you picked that up. We've already made this chapter 12 of this folder available 2 weeks ago. So as we say there, this part of the content folder, or folder 12 or chapter 12, is made available even before the commencement of term 3. So this was made available 2 weeks ago for the benefit of students who want to start early. So you can already have a look there. That there are 2 lectures there by Mr. Adam. They were recorded not during a live class. They were recorded separate from a live class. That is just to give you an alternative view, ladies and gents. You know, each lecturer has got his or her own style. Ms. Morris got her style, I've got my style, Mr. Adam got his style. By the way, this is not Mr. George Adams, this is Mr. A.B. Adam. He is going to be lecturing in Financial Accounting 3 and Financial Reporting 4 this year. He was going to join us in the second semester, but unfortunately one of our Financial Accounting 3 and General Reporting, Financial Reporting 4 lecturers are moving over to UWC. So he's going to replace her. So those 2 you can have a look at already. The first part 1 is 32 minutes long, and the other one just a minute or so longer. So that gives you also some more background on value added tax. Then if I can just go back to that folder, topic 8. There's one folder that you cannot see yet. I'm going to let you see it now. I just want to go exit the preview. So let me just go to content per topic again and topic 8 value tax again. The very top folder here, it's still hidden from you, but it will become available today. It is called What is VAT and How Does It Work? What is VAT and How Does It Work? As you can see there already under the learning outcomes, the live online class, which is today, the 21st of July 2022, the recording thereof will be loaded there. So once we are done with today's class, it takes about 20 minutes or so for the recording to process. It takes us about an hour or so to download and upload it. But let's say by about 2:30 or thereabouts, then you will find in this folder the recording of today's class, as well as the slides that I'm going to be using in a little while. And as well as just a whiteboard that I've created for us. I've actually typed a few short little notes or reminders in there, but I'll post that there as well. Okay, ladies and gents, so that is what you can find on the website. Um, Let me just stop sharing that, and then this is a good time to just see whether there are any questions in the chat that I have to attend to. I'm sure Ms. Morris would have attended to most.
Hi, sir. Okay, I'm sorry to interrupt. Students, I don't
No,
know
you're welcome.
whether, because I've seen now that there was 3 more responses that were received because it was on 229 and now it's on 232. So they are still responses, but I'll just open another link quickly and then I'll just have it open for the next 3 minutes. Just give me 1 more second. Thank you, sir.
Thank you very much, Ms. Morris. I presume you were talking about the register there.
Yes, sir. The students,
Oh,
some students are unable to complete it now. So I'll just send a new link. Thank
okay.
you. But if you
And
have,
is
sorry to
the
interrupt. If you've already completed it, please don't complete it again. It's only for those that are unable to complete the register now. Thank you.
Thank you very much, Ms. Morris. Okay, ladies and gents, so now let's talk about value-added tax. Now, I want you to consider a few things before I even display my little slideshow, and before we start discussing our topic in detail. I just want to ask you a few questions, ladies and gents, and you are welcome to speak. You are welcome to answer in person. You are equally welcome, as always, if you want to type it in the chat facility. Now, I know some of you, a handful or maybe more than a handful, some of you actually do part-time work and you may therefore be registered for income tax purposes. Like our tutors, if you're a tutor at CPUT, you are doing a part-time, you have a part-time work or a part-time job, which means you have to register for income tax purposes. My first question to you, irrespective, excuse me, whether you are registered for income tax purpose or not, do you think that each and every one, and we almost on 250 in this class, do you think each and every one of us are paying taxes? Yes or no? Are we paying taxes or not? Ooh, looks like this is unanimous. There's one or two no's, but most yes, 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 sir, yes, yes, yes. One or two no's. Now you may find, I think many of you know this, but some of you clearly may find this as a big surprise, or maybe I should rather call it a big shock. Zaria Peterson has got it spot on, not income tax, but other taxes, yes. Very often those taxes are referred to as hidden taxes. I'm going to give you a number of other terms today as well. Yes, everyone does, even a baby. Thank you, Sisu. But only if the baby can buy something. So, yes, I like that. So we often refer to that as hidden taxes, but like I say, we're going to give you a few more official terms. So can you give me two examples of a so-called hidden tax? The one is very obvious. VAT. Yes, through value added tax. Thank you all. Right. Value added tax. So each and every one of us, as soon as we purchase something, there are a few exceptions to the rule, which we will discuss during the course of this morning. But normally, every transaction that we do, every time we go and buy something, if we buy a shirt, or if we buy rusks, or if we buy trousers, we are actually paying a tax, and that tax is called value added tax. And we are going to discuss exactly how it works. It is also referred to as an indirect tax. And ladies and gents, Later, when I'm going to give you a definition of value-added tax, I'm going to come back to this term indirect tax. But let's maybe discuss it already. What is meant by an indirect tax? Well, I guess the best place to start such a discussion is to perhaps first think of what is a direct tax. So, what would you say? We've already mentioned this a little, or you mentioned this a little bit earlier. What is an example of a direct tax? A direct tax. Income tax. Thank you, Lutando. Thank you, everyone. Yes, a direct tax. Why is that a direct tax, ladies and gentlemen? Well, you can basically say it in two ways, or you can justify it in two ways. First of all, it gets paid directly to the revenue service by yourself. There might be a middleman. I think somebody actually mentioned PAYE somewhere in the chat there. There might be the middleman, your employer, who might deduct it from your salary or deduct it from your wage and then paid over to the revenue service on your behalf. But you, as an individual, as well as companies, you have your own account at the revenue service in your personal capacity. So unless you fall under the site system you'll learn all about in tax standard income tax on employees. It means you have to complete an income tax return at the end of the tax year, right? So that's why that is a direct tax. You are dealing directly with the revenue service, and that tax, the second justification is that that tax is levied on you as an individual or your company as an right. So that is therefore a direct tax. So what is now different? Why is value added tax then an indirect tax? Okay, I'm not going to expect you to type the long story, but what it comes down to, you as an individual, you do not have a value added tax account at the revenue service, right? Only what they refer to as registered vendors, and we are going to talk about registered vendors a little bit later on, only they have accounts at the revenue service. So what is their responsibilities? Their responsibility is to charge value-added tax on each supply that they make. We're going to come back to the word supply a little bit later. That is used by the Value-Added Tax Act. So they have to raise value-added tax on the supplies that they make. They are allowed to deduct the value-added tax on the supplies that they have received, and we'll give them terms later on, and then they have to pay the difference over to the revenue service, right? So you as an individual, even though you bear the brunt, you are the bearer of that tax, you are the one paying it, and you are the one for who it is an expense, you do not have an account with a revenue service. So that is the one justification. The other justification is simply that it is not an individual or a company or any entity specifically that is taxed, rather it is an action that is being taxed. And that action is a transaction. As the Value Added Tax Act states, it is for the supply of goods or services, right? So therefore, you are all taxpayers, ladies and gentlemen. What do we call ourselves in general? This is also a term used by the Value Added Tax Act. What do we call ourselves? We, the general people who actually bear the tax. Remember, the company or the business that raises the tax, it's never an expense for them, right? It's never an expense for them. So you will never find in any financial statement, in any statement of comprehensive income or any statement of profit or loss, you will never find an item called value added tax expense, because the expense is not on the business, the expense is for you and I, the people who are buying the goods or who are receiving the services. So what is a good word to call us? It starts with a C. Let me give you a hint there. We are the consumers. Thank you, Tembela. Perfect. Thank you, Caleb. Thank you, Mercedes. Thank you, Aneswa. They're consumers, right? So we consume the services or we consume the goods. So therefore, we are the actual taxpayers. Yes, Miss Morris.
So in the chat, Enrique has quite a good question. He asked, is levies a type of tax, sir?
Thank you for that question. That reminds me, actually, ladies and gentlemen. Well, the short answer is yes. That reminds me. I actually said earlier, let's think about a few kinds of hidden taxes. So let's think of another kind of hidden tax that is quite obvious. It is a levy. It is a sort of a levy. Thank you for that question. Let me just see where I missed that. But anyway, Miss, there. Thank you, Enrique. Yes. So there is an obvious one that is also a kind of a hidden tax, ladies and gents. What do we call that? Every time you ride on a bus, there's a skills development levy. Yes, skills development levy. So it will be some kind of fuel levy. That's right. I was just about to say that there's another kind of levy that all of us are paying, but you might not even know about it. Now, even though you're a passenger in a bus, in a My City or a Golden Arrow or a minibus, you do not directly pay the fuel levy, but obviously the fuel cost, a large portion, a very large portion of the fuel cost includes a fuel levy, and that is another kind of tax, right? That is another kind of tax. So obviously the operator of the bus, that person who actually puts fuel in the tank, must pay the levy. So therefore that increases the price of your ride. You may know that certain organizations, because fuel has become so incredibly expensive over the last few months, before the lockdown, I think it was less than 10 rands a liter. And now 2.5 years later, it's more than 25 rands a liter. So there's been some entities and organizations like the Automobile Association of South Africa, for instance, the AA, that have requested the Minister of Finance to actually get rid of that fuel level because it really makes fuel incredibly expensive. Like I said, I'm not sure what percentage it is, but it is a very large portion of your petrol price is a fuel levy. And that is another kind of hidden tax, right? That is another kind of hidden tax. Lucille, what is explaining what a levy is? A levy is just something that is added onto a cost price. So it really is a nice way of hiding the fact that it's actually a tax. It is a tax. There's an old saying, there's only two things sure in life, and that is death and taxes. You cannot get away from that. Uh, I wouldn't say I wouldn't say inflation. Inflation is more an economic indicator. So inflation indicates how much you look. There are various inflation indicators, but generally they indicate by how much prices are going up. So you have your inflation on food stuff, and then you've got a general inflation and so on. Okay, ladies and gents, I think we should stop there. So those are another more examples of hidden taxes, right? Your various levies. Obviously, those of you who are maybe I should just mention one more. One more. Are there any smokers in class? Yes or no, or you could just stay quiet if you are ashamed of it. Now, you may or may not know that a large part of the price of tobacco. Okay, so some of you are not shy to. So, thank you, Caleb. I was about to work. Thank you, Adeline, as well. I was about to work towards that. Now, it is also a levy. It's an excise. In that case, I actually do not call it a levy. They call it a duty. They call it an excise duty. Another way of hiding the, thank you, Mpisani. Yes, excise duty. Another way of hiding that it's basically a tax, right? So they call it a duty or a levy, but it is another tax. It's another source of income for the government. In fact, during those months in 2020, when there was a cigarette ban or a tobacco ban, besides the fact that many people managed to get uh, uh, illegal cigarettes and tobacco, which wasn't that difficult, but the government lost us something like 54 billion rands in sin taxes, right? So that is what they very often call it, a sin tax. Also, with the excise duty is also on alcohol, for that matter. So now I'm going to ask you: are there any of you who consume alcohol, or are you too shy to admit that? Yeah, we do once in a while, a little tippy here and a little tippy there. Yes, they all do. Okay, so also a large part of the price of your favorite little beverage there is a duty, right? It is excise duty, so it's another form of a so-called sin tax. That is very often you will find is the petrol levy 33%. Thank you, Ms. Morris. I wasn't sure of that. I just know that it is a substantial part. Abigail Maliwa explained estate duty. Okay, and okay, that's the last part that we're going to talk. Besides getting to value-added tax, estate duty, ladies and gentlemen. What happens there if a person passes away? They all their assets minus their liabilities, in other words, their net assets, form part of their estate, right? Forms part of their estate, and then that estate, there are exemptions. There are certain amounts that are exempt, and there are also certain rebates. But most of that estate will then be taxed before the assets go to the heirs of that estate. So if you're going to inherit something, it would have been already subject to estate duty. Okay, so that's another form of tax, but that one isn't really hidden. I must say that's a very open one. Okay, ladies and gents, so can we start now talking about value-added tax as a topic, or are there any other questions? I think we'll have to start with value-added tax now, otherwise we might run out of time. Thank you, Zikona. Okay, I've just got a short little, it's only about 10 slides, I guess. There should be an 11th. I only thought about that about an hour before the class started. There's another slide that I will add before I load it. So this is just to remind us that we do not forget anything that we really want to discuss. Let me just wait to appear on Blackboard on your side. There we go. So that is just the textbook that we are using. Let me just close that tab. We're done with that. Okay. So whether it's the 8th edition or whether it's the 7th edition you are using, you will find it in chapter 10. So let us go to the second slide there. You will also find this in your textbook. This actually comes directly from your textbook. So they are saying the objectives here by the end of this chapter, you should be able to define value-added tax, and nowhere in the textbook is it defined. So I'm going to give you a nice little definition just now. Distinguish between the different types of value-added tax. We'll talk about that. Explain when, that is actually where I thought this morning I drew up, or I worked on this slide. This is part of a slide that I received, but I've worked on it yesterday or the day before, I think. But only this morning I realized I should have added another slide that indicates the different types of VAT. But anyway, we'll talk about that when we get to it. Also, you should be able to explain when value-added tax input is prohibited. Now, input, we're going to talk about the meaning of that soon. The input VAT is the VAT that a business pays to a supplier of theirs. So in other words, on their purchases and acquisitions. So if the business acquires or procures something from a supplier and they pay value-added tax to the supplier, That is referred to as the input tax. The value added tax that is added by the business on their sales or on the services they render, we are going to call that the output tax, right? The output tax. Then we've got to be able to apply the value added tax principles for the recording of goods bought and goods sold, as well as services rendered. So we are going to focus on the accounting side, right? This is what we are training ourselves for. Also, we must be able to calculate the value added tax due from the revenue service if our input is more than our output for a certain VAT period, or that is payable to the revenue service if our output tax is more than our input tax for that specific period. Now, normally, ladies and gents, maybe I can just expand a little bit on this. Normally, in any trading or any service industry, your output tax, in other words, what you charge your customers, should exceed your input tax, what you have paid to your suppliers. If it doesn't, it means you're operating at a loss. It's as simple as that. So normally that would be the case, which means at the end of every period, by the way, a VAT period is 2 months. You have to submit the VAT return. The VAT return is called the VAT 201, which by coincidence I designed in 1990 when I was still at the Revenue Service. So it's called the VAT 201 return. So that has to be submitted every second month. There are a few exceptions. If your revenue is more than, I think, 10 million rands a month, 5 million rands a month, then you have to submit it monthly. So that will only be in the case of large businesses, right? If it's more than 5 million a month, not a year, a month, then you've got to submit it every year. There are also certain smaller entities which are allowed to only submit a return once a year. But anyway, for our purposes, we are going to be the average business. We are going to assume that we have to submit it every second month before the 25th of the following month. So let's return to the value added tax definition, ladies and gents. So what I suggest as a good definition there, and this comes from just interpreting the Value Added Tax Act. So value added tax is an indirect tax, and this is where you should take notes now, please. So value added tax is an indirect tax, and then I would say in brackets a transactions tax. A transactions tax is a type of an indirect tax. So value added tax is an indirect tax, brackets, transactions tax on the supply. And I'm stressing the word supply because this word supply appears in every second section of the Value Added Tax Act. On the supply of goods and services. Right, so that is going to be our definition. So there we've got, there we've just added value. Just to say one more time, okay, no problem, if I can remember it actually. What did we say? Value added tax is an indirect tax, and then in brackets we say a transaction tax on the supply, SUPPLY, on the supply of goods and services. Happy? I guess all happy. I don't see any objections. Okay, so then let's thank you, Ms. B. Right, so let's then carry on. Thank you all. Thank you all. So just as an introduction, ladies and gents, we've just added the value added tax, which we've already said is an indirect tax, is a form of taxation that is sort of hidden from people who don't know about it, and is part of the government's fiscal policy. The fiscal policy is basically how do you balance your money, right? Where do you get money from to be able to pay for, let's say, the fixing of roads or whatever the case might be, whatever is needed to properly do the administration of your province or the administration of your country in the case of value added tax. It is a comprehensive tax that is levied on most goods and services. Now, we'll see later on there are exceptions. I can already mention maybe two here. Brown bread is an exception. Brown bread is not, it is subject to value added tax. Let me put it that way, but at a zero rate. We'll talk about the various kinds of value added tax soon. There are basically three possibilities. Also, milk is not subject to value-added tax. It is taxable, but at a rate of 0%. We'll talk about that soon. Uh, and then, just as we've discussed earlier, because it's an indirect tax, we as an individual hasn't got an account for value-added tax at the Revenue Service. Only the vendors, the people, the businesses who are registered vendors for value added tax purposes, they have accounts there at the Revenue Service. Okay, then that consists of two components, and especially from the point of view of recording this, this is important for us. So we must really know exactly what this is, ladies and gentlemen. Uh, so, as we've said earlier, we can distinguish between the value added tax that we pay to our suppliers, right? That is levied by the supplier on the goods and the services that they provide to us as a business. Now, when I say we've now got to put ourselves in one of two situations. Either we are the owner of a business or we are the accountant of a business, right? So if I talk about we, I'm talking about from a business perspective now, not an individual, right? Not us as consumers. So maybe you can just start for me, yes or no. Is that clear? Yes, Mercedes. Also fruits and vegetables. They are also zero rated. Okay, so you're all happy with what we are talking about now. For the point of view of a consumer, we bear the tax. But from the point of view of a business, they don't bear the tax. Thank you so much for all those answers. They just do the administration of the tax. So what they are really doing, and this is a term we actually used when the Value Added Tax Act was developed in the 1989 and 1990. We said that for all practical purposes, each business becomes an agent of the Revenue Service. So clearly, ladies and gentlemen, if any business should not pay over the value added tax to the Revenue Service, it is theft. They are stealing money which has never ever belonged to them. So they are just administering the process of collecting the taxes and paying it over to the Revenue Service on behalf of the Revenue Service. So, for all practical purposes, each registered vendor is an agent of the Revenue Service. Please remind me, ladies and gentlemen, I think I've got it in one of the later slides, but if I haven't, please remind me to talk about compulsory and voluntary registration a little bit later. I might forget about that. So, ladies and gentlemen, if you can type for me that value added tax that we are paying to our supplier, what are we going to refer to that as?
Mr. Colin, are you still there?
Oh my word! I've been talking such a long time with my microphone off. I'm so sorry, students. I'm terribly. I have to apologize terribly and profusely here. I was actually I was actually paying some of my syntaxes, and I didn't want you to hear when I was lighting my syntax. And I switched off the microphone, and then I forgot to switch it on again. Okay, so what I was saying, ladies and gentlemen. So, oh, now where did I switch it off? Let me think.
You
So what I
were
was
sorry, you were asking regarding whether or not when you're purchasing goods, whether you'd be paying input or output.
Okay, and then that's
That
where all
input
the
is that
students
out.
answered the output. So that input, that is where the last time you heard me. I'm so sorry. I feel like an idiot. Thanks, students. Moron. But anyway, so what I was saying to myself here is, why is it important? Okay, maybe I should just go back to where I think you might have lost me from my own stupidity. I said that when you are making any payment, or you are incurring any transaction with your supplier, if you are uh, acquiring goods from a supplier, or you are acquiring a service from the supplier, it is very important to keep the amount without the value added tax, which we refer to as the exclusive amount. In other words, the amount excluding the value added tax, separate from the VAT input. And that, I said, unfortunately, you couldn't hear that. That is what I said is probably the first important accounting consideration when it comes to value added tax. We have to separate the exclusive amount, the amount that the supplier is not going to pay over to the revenue service, and the VAT input that our supplier will be paying over to the revenue service. So my question was there, why is it important for us to separate the exclusive amount from the VAT input? Yes, Sisi, you have correctly answered, Lindo there. Why is it important for us to keep those two amounts separate? We briefly mentioned it a little bit earlier. The reason for that, ladies and gentlemen, is because you, as a business, a registered vendor, you are allowed to deduct the input tax from the output tax that you are going to be raising. So clearly, you have to keep a record of that. You have to keep track of it separately. And we'll talk about that once we've discussed this slide. We'll talk about that mechanism. So the other side of this mirror, the other side of this coin, ladies and gentlemen, the value added tax that we charge on our goods or services that we supply to our customers, what are we going to be calling that? All together now, that's easy. It's the other one now, right? VAT output. Thank you, Aneswa. Thank you, Silungile. Thank you, everyone. That is our VAT output. Now, again, ladies and gentlemen, why it is important. Thank you so much, students. You are on fire as usual. Thank you so much. Why do we have to keep a separate record of our VAT output, separate from the amount that belongs to us? Remember now, when we are selling goods or when we are rendering a service, a certain part of that amount belongs to us as a business, and 15% of that belongs to the revenue service, which we must pay over to them. So, why is it important to separate the two? Because of the mere fact that part of it belongs to us and the rest does not belong to us. So the VAT output must be paid over to the revenue service after deducting the VAT input. Why is that, ladies and gentlemen? If that hadn't been the case, then we would have had a situation of double taxation, triple taxation, quadruple taxation. Then, if that input tax, if you were not allowed to deduct it, it means that every time that a transaction is taking place, whoever is the recipient of that goods will be bearing the tax. And that is not what this tax is about. Only one person bears the brunt of this tax, and that is the ultimate what? You've typed it earlier. You can just type it again. I just want to see whether you remember. The ultimate co- 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 consumer. Thank you, Anesva. So only the ultimate consumer bears the full amount of the tax. And the mechanism by which means it is done is that in every phase of the transaction, from where it comes from the manufacturer, right until when it ends up in the hands of the consumer, the full 15% VAT output is raised, but the VAT input can be deducted. Can be deducted. Shamila, you say you don't understand the difference between VAT output and VAT input. The simple difference there is VAT output. Okay, let's put it this way. If you are acquiring goods from a supplier, the goods that you are acquiring or the services that you are acquiring, is that input or output into your business? The goods, I'm not talking tax now, just the goods. If you can answer me, or anyone can answer me, if you buy goods, it's input. Yes, thank you, Enrique. Purchases will be input. So if you buy goods, thank you, viewer. So if you buy goods from a supplier or you receive services from a supplier, then it means you are inputting stuff or inputting services into your business. And the tax that that supplier must levy on the goods is for them output tax, because they have to pay it over. But we are going to pay that tax to the supplier, right? Not to the revenue service, but we can then deduct it from the amount that we are going to charge our own customers. When we are selling goods, or we are rendering a service, is that an output of goods from our business or an input into our business? I think everyone will know that answer, but type it anyway. It's an output. Thank you, Lutandu. Thank you, Milelu. Okay, so everyone, thank you. So clearly the VAT that is associated with that, an appropriate name for that is output VAT. Does that make it clear the difference now? I forget now who asked the question. So your VAT input is the VAT that the business charges on when they supply goods or services to their customers, right? And the input is the VAT that is being charged by the supplier of that business to you as a business, which you are allowed to deduct from the output tax before you pay the net amount over. So that ultimately, we're going to talk about the concept of value added later on. Once I'm done with the slideshow, I've got a few notes on my so-called whiteboard. Then we're going to talk about the principle of added value. But the principle here already is in action. So that the tax, why is the tax raised at every point in time? Ladies and gentlemen, this is not for test purposes. This is just for background. Before value added tax was implemented, and this I'm just giving you for general information. Before value added tax was implemented in 1990, I think it was November 1991, if I remember correctly, we had a system called sales tax. So there was already an indirect tax on transactions, but it was called sales tax. And the sales tax was only charged at the very last point of sale. Somebody mentioned POS, point of sale, earlier. So only the final retail business would charge the full amount of sales tax. So nowhere up front would there be any tax charge. So if that person then stole, that last business stole the money, they stole the whole, all the tax on that transaction, right? Now, if so, this is a more secure system. The value-added tax system is more secure than a purely sales tax system, because if that final person in this chain of transaction, that final business, if they steal the value-added tax, then at least in all the previous change, chains, part of the chain, all the what do they call it, parts of the chain. Anyway, uh, the tax would have been paid over to the revenue service. So the revenue service is only losing that small portion right at the end of that chain of events. Anyway, so that was just for interest sake. Um, what did I say? I always also wanted to mention. Oh, the voluntary and compulsory registration. Ladies and gentlemen, um, when it comes to value added tax, if a company has got income or supplies, let's call it supplies because the supplies, that's the word being used by the Value Added Tax Act. If the company has supplies of more than 1 million rands or more, 1 million rands or more per year, right? So this is now per annum, not per month. If the business, whether it's a company or a sole trader or a partnership, any kind of business, if that business has got supplies of goods or services equaling or exceeding 1 million rands per year, it is compulsory to register for VAT purposes. They have no choice. They have to register for VAT purposes. That has two implications. That means they become a registered VAT vendor. That is also an official term in the Value Added Tax Act. So they become a value added tax vendor. Secondly, the big implication is then they must complete a VAT 201 return every second month, which in turn means that they've got to pay over the difference between their output VAT and their input VAT when they submit the return. If the business has got supplies, whether it's supplies of goods or services of less than 1 million rands, they do not have to register for VAT purposes. So then it is not compulsory, but they are allowed to register for VAT purposes. So they can do so voluntarily, right? Voluntary registration. Thank you, Zikona. Now, what are the implications if a business is not registered for VAT purposes? Let's maybe talk about that. We're just going to talk about that now. Once, then you know about it, and then we're not going to talk about it in this topic again. So, if a business is not registered for VAT purposes, if they if they've got supplies of less than 1 million and they do not choose to voluntarily register, so if they're not registered, what is the implications? The implications, firstly, is that they are then not a registered VAT vendor. So they're not a vendor with regards to the Value Added Tax Act. What is the second implication, ladies and gentlemen? The second implication is that that business then they do not have the means, they cannot submit a VAT 201 return at the end of every second month, right? Because they're not registered, they've got no means, they're not even going to get a blank return to complete and to return, right? So they cannot uh, 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 submit a VAT return. What is the implications of that? Inati, I'm getting there now. Thank you for that question. That is my next part that I'm going to say. So what is the implications of that, ladies and gentlemen? The implications of that is that that vendor, which is not a VAT vendor, but is just a business, is not allowed to charge value added tax on the transaction, right? So they may not, it is illegal to add value added tax uh, to any of their sales or any of the services rendered. But also, ladies and gentlemen, just to take this argument further, because they cannot submit a VAT 201 return, they also, in that case, do not have the means to claim back input tax VAT, right? So this is a two-edged sword. They cannot claim back the value added tax, the input tax, but they're also not allowed to raise it. So, ladies and gentlemen, if you can type for me a little word there that you've already typed many times before. So in a case of a business who is not registered for value added tax, they in effect become the final, if you can type for me, they're in the same position as a consumer. Thank you. Thank you all. So then that business is actually bearing the final value added tax, right? Because they cannot claim back the input tax, but they can also, they're not allowed to raise any output VAT. So therefore, a business that is not registered for VAT purposes is in exactly the same situation as the final consumer. Thank you. Let's carry on to the next one. Now, this is where I actually want to include a further slide, ladies and gentlemen, between this one and the other one. So if you will just bear with me after class, before I'm going to load this slideshow, I'm just going to add a little slide there. We generally get two kinds of supplies. Maybe I'll just move away there. And this is what my additional slide will be about. Let me just make sure that my microphone is on. Yes. Sorry. So we get two kinds of supplies, ladies and gentlemen. Now, when we're talking about supplies here, it could be either supply of goods or it can be a supply of services. But we generally get two kinds of supplies. I wonder if someone will attempt to type it in the chat facility for us. What is one type of supply? You've actually briefly seen the one type now. Okay, don't worry, because these terms will probably be new to you. There we go, Sibongile. You've seen the one. The one type of supply is a taxable supply. Thank you, Mbuyele, Neliswe. All of you, thank you. Neliswe, we'll get to that zero rated. That's a specific kind of taxable supply. You're quite right. So we get taxable supplies, ladies and gentlemen. Taxable supplies, and then you also get something called exempt supplies. Exempt, maybe I should type it there. But I will put it in an extra slide there. Exempt supplies. So you get taxable supplies and exempt supplies. Now, exempt supplies, ladies and gentlemen, exempt supplies, and this is important to note, exempt supplies are supplies that are not subject to value added tax, right? So whoever performs that service or whoever provides those goods are not allowed to raise any output VAT on that specific supply. This is now in the case of an exempt supply. At the same time, ladies and gentlemen, what I'm saying there, Pabalelo, is that if it's an exempt supply, I'll give you some examples just now. An exempt supply, then the supplier of the goods or the supplier of the service is not allowed to raise output tax on the supply. But at the same time, and this, ladies and gents, is important to note because this is the difference between an exempt supply and a zero-rated supply. In the case of an exempt supply, that supplier of goods or services of the exempt supplies are also not allowed to claim the input tax. Right. So if it's an exempt supply, they cannot raise value added tax, but they are also not allowed to claim the input tax. Sibongile, yes, life insurance is an exempt supply, but remember there are certain fees involved when it comes to insurance. So if they charge you certain fees, then they are taxable supplies. Okay, so Purity, if you are okay, it all depends, Purity. If that business only makes exempt supplies, then they don't need to register for value added tax, right? But very often you may find that a certain business, part of the business provides taxable supplies, and other parts of the business are exempt supplies. I'll give you an example just now. So then they must separate the two. That the taxable supplies on which they must calculate them, they must add the VAT output, and which they are allowed to claim the VAT input for, that is kept separate from the exempt supplies, where they are not allowed to charge output VAT, but they're also not allowed to claim the input VAT. Ladies and gents, the most obvious, or the most well-known, I guess, example of an exempt supply is the supply of residential housing. And very important, ladies and gents, we are using the term residential, right? Residential, not business, but residential. So if you are a resident of a house, in other words, you are an ordinary person, you are using that as your living quarters, whether it's a house or a flat or an apartment. It means you are not paying value added tax on your rent. So rent, residential rent, rent for living purposes is an exempt supply. However, if you are renting out premises for business purposes, so if you are renting out, let's say in a shopping mall, uh, 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 to other businesses, then it is a taxable supply. So to answer who asked that, somebody asked that, I forget now, but anyway, to answer that question, should they register? It all depends. So you will very often find, when it comes to an estate agent, what do? They rent out houses and flats, and other apartments, townhouses, and so forth to private residents, which is exempt supplies, but they might also rent out stores in a shopping mall, right? Which is a taxable supply. So in that case, if the taxable supplies exceed 1 million rands a year, they have to register for VAT purposes, but then they must keep the exempt supplies separate from the taxable supplies. Okay, ladies and gentlemen, so you will see there are a few other examples in your textbook, but like I said, the most commonly encountered one is residential rent. That is an exempt supply. Yes, Ms. Morris.
Sorry, sir, to disturb. The students can have a look after the session. I just posted a link to a PDF that does list some of the zero-rated and exempt supplies. So it does give a short explanation. It's just 2 short pages that they can also then just use just for further clarity. Thank you,
Fantastic.
sir.
Thank you so much, Ms. Morris. Yes, that is a brilliant idea. So there you can get a more comprehensive list. We really do not have a time to go through all of them. It's especially when it comes to zero rated, there's quite a long list. Anyway, okay, so now the second category. So we've got exempt supplies, and then we've got taxable supplies. Your tax. Ooh, let me just check whether I switched my mic on. Yes. Okay. I'm now a little bit worried. Okay, so when it comes to taxable supplies, there we can now subdivide that into standard rated supplies and zero rated supplies. Standard rated supplies and zero rated supplies. Now, value added tax, when it was first introduced in 1991, it came in at 10%, then it was increased to 11% after about 10 years. And then after about 5 years, it was increased to 12%. And then after another few years, it was increased to 14%. And I think 2 years or maybe 3 years ago, it was increased to 15%. So it's creeping up on us. In fact, that is called tax creep, tax creep, where your rates become higher over time. Now, ladies and gents, maybe you can type for me here. Now, if you have a standard rated supply, right? Standard rated supply, it means that you have to charge 15% on your selling price to your customer. So if you are going to sell something to your customer at 100 rands, How much must you add? If you can type for me there, please. How much in rand terms must you add? If you supply your money, the money that belongs to you, you supplied, in other words, the exclusive amount is 100 rand. Exclusive amount, this is what belongs to me as a business. I'm going to charge my customer 100 rand, which belongs to me. How much must I add that is not going to belong to me, that belongs to the revenue service? 15 rands. Thank you so much. You are, like I said earlier, on fire. So quick. I don't know how you are, how one can type so quickly, but anyway, uh, 15 rands, right? So you've got to add 15 rands. So if you use the exclusive amount, how do you determine the tax, the value added tax, your output tax? You add 15% to the exclusive amount. Now, ladies and gentlemen, before we talk about zero rated supplies, let's just go a little bit further with this argument. Now, how much is going to be the amount that you're going to charge your customer in total? If we have this scenario, how much are you going to charge your customer? Thank you so much. 115 rands. 115 rands. Exactly. Exactly. Thank you so much. The Value Added Tax Act calls that, and perhaps you can make a little note there. I think it is somewhere in the slides as well. So if you don't make a note, it's not the end of the world. That is called the consideration for the transaction. So your exclusive amount plus your value added tax, in other words, your inclusive amount, is referred to as the consideration for the transaction. Now, ladies and gentlemen, let me test your mathematic abilities. If you get this inclusive amount or the consideration, and you want to calculate the VAT on that consideration, which formula are you going to use? If someone or many of you can type for me there. If you are given this consideration, the inclusive amount, how are you going to calculate the output tax included there? Thank you, Simam Kele. Uh, Thank you, Nati. Thank you, Owetu. Okay, it depends what you want. Some of you have said the 100 over 115. That will give you the exclusive amount. So there are two things that you can calculate here. If you want to calculate, thank you, Inati, the last one there. Thank you, Angel. There we get again. What I want over what I have. I get that now. You wrote that with when we did inventory. I remember so well. Thank you, Angel. What I want over what I have. So I get that now. That's brilliant. So if you want to calculate the output tax that's included there, you will take 15 over 115, as Inati indicates there, right? In other words, very similar to our profit calculations. Remember when we spoke about profit margins and markups, it's a similar kind of concept. So now, if you want to calculate the output tax and you have the consideration, the inclusive value, you can't just take 15 over 100 because that inclusive value represents, like Angel said, it represents 115. Okay, so to calculate the output tax, you will take 15 over 115. And then some of the students earlier in the chat, they also gave us a different formula. And that was for if you want to calculate the amount that belongs to you, the amount that belongs to you. In other words, the part of that total transaction that you are not going to be paying over to the revenue service. How do you calculate that? There are quite a few that answered that. The one that I can still see here is Adelaine. So there you would then take 100 over 115 multiplied by the total consideration or the inclusive amount. All happy with that, ladies and gentlemen? So it's a similar principle to markups and profit margins. All happy? Smiley face or sad face? In RT, if it's 100 over 115, what you calculating? You are calculating the exclusive amount. In other words, the amount that belongs to you as a business, the amount that you are not going to be paying over to the revenue service. That is your part of this transaction as a business. Now, zero-rated supplies, ladies and gentlemen, it's a taxable supply. It's a taxable supply, so it's not an exempt supply. But the rate being used is zero. Right, so it's taxed at a rate of zero. Examples of that, we've mentioned quite a few already. We've mentioned milk, we've mentioned brown bread, not white bread. White bread is seen as a luxury. Things like maize meal, so your basic foodstuffs. Basic foodstuff, maize meal will be a zero-rated supply. I think somebody in the chat mentioned their fruit and vegetables. Purity, I'm going to explain that just now. You are actually charged VAT, but at a rate of 0%, so you are actually not charged VAT. You know what I'm saying? So it's not an exempt supply where they don't add VAT whatsoever. It is a zero-rated supply where VAT is added at 0%. So no, not 1 cent is added. So when it comes to monetary terms, nothing is added. So what, ladies and gentlemen, what is the difference? If somebody, I think this might be a long story to type, so if somebody wants to maybe say it in person, what is the difference between a zero-rated supply and an exempt supply? In the case of an exempt supply, they are not allowed to add value-added tax output, right? In the case of a zero-rated supply, they have to add it, but at a zero rate. So what is the difference? Anybody wants to tell us what is then therefore the difference? Zariah, yes, please speak to me.
Sir, can you hear me?
Yes, yes, I can hear you clearly.
Okay. I think a zero-rated tax would be things that have tax added at a zero rate, but they can have tax added at a later point should the government decide. But an exempt product or service is something that you can't add tax to at all.
Thank you, Zariah. That is one very good explanation. There's another reason that we'll get to, but that is exactly one of the reasons, right? So, ladies and gentlemen, when it comes to an exempt supply, such as residential housing, it will remain exempt. But when it comes, very well said, I agree with you, Sibusisa, very well said, Zariah. When it comes to zero-rated supplies, the government publishes, and I think that might be one of the documents that Ms. Morris has made available to you. The government may decide at various times this is zero rated and this is now not going to be zero rated. For instance, for many years, sugar was zero rated, and then suddenly a few years ago, I can't remember how many years ago, the government decided no, sugar is unhealthy for you. They say, I don't know whether it is. I've been drinking sugar for more than 60 years. But anyway, and they also say it's a luxury item. It's not a basic foodstuff. So they decided to change sugar from a zero-rated supply to a standard-rated supply. So they can mix and match there. So that is the point that Zariah made there, right? You all would have noticed about a month after sugar was not zero rated anymore, all your cool drinks and all your chocolates went up in price. Yeah. It must be someone who doesn't like chocolate, I'm sure. Okay, so your basic foodstuffs are zero rated, like someone mentioned in the chat, fruit, vegetables, and we mentioned maize meal, things like that. Yes. There's another big difference, ladies and gentlemen, and this is the one that I'm not going to expect anyone to mention. Or maybe if does someone want to try something else? I'll give you 30 seconds. If there's no hand up, then I will give you the other big difference. But if somebody wants to try, Zariah gave us one good reason. There's another one, or another big difference. Maybe 30 seconds would be too long. Then we're going to be tight for time. No one wants to take this gamble. Okay, the other big difference, ladies and gentlemen, when it comes to a zero-rated supply, where you theoretically add output tax at 0%, you can just type for me yes or no. Are you allowed to claim back your input tax? This is a taxable supply, but it's at zero rate. Are you allowed, yes or no, are you allowed to claim back your input tax that you paid to your suppliers? Yes. Thank you, Linda. Thank you, Izile. Thank you, Mr. JT. There's a lot now. So when it comes to a zero-rated supply, your output tax in rands and cents, dollars and pence, or whatever currency you are using is going to be zero, but theoretically it is a taxable supply at 0%. But you are allowed to claim it back, ladies and gents. You are allowed to claim your input tax back. Another good example of a zero-rated supply, just as a matter of interest, is exports. Any goods that are exported to another country is zero-rated. In other words, the exporter can claim back all the value-added tax, all the input taxes. How much will you get back? All the total amount of input tax on your transaction. We'll look at that later, Inati. Don't worry, we'll look at an example. Everything that you've paid as input to your supplier, you can claim back. So here, ladies and gentlemen, the exporter, they can claim all the input tax back, but they don't levy output tax because value-added tax is only on the consumers that are citizens of South Africa, right? It's only a tax on South African citizens. We are not allowed to tax foreigners, not even with income tax, right? You can only tax your own population. Same applies to value-added tax, right? So if it's exported, that's another zero-rated supply. So you can claim back if it's a zero-rated supply, you can claim your input tax back. Can you claim the input tax back on an exempt supply? Yes or no? You can type for me, please. No, thank you, Izile. Thank you, Nelita. Adeline, thank you all. Too many to mention. Thank you all. So on an exempt supply, you are not allowed to claim your input tax back. So that is another major difference between the two. Okay, ladies and gentlemen, I think that should be pretty clear now. So let's go to our next little slide here, value and consideration. We've actually already discussed that. So they say the value of a supply, in other words, the amount that belongs to you as a business, is the amount excluding the value added tax, right? Excluding. So in our little example before, it would have been the 100 rands. The consideration amount, the term that the Value Added Tax Act uses, the consideration amount is the amount including the VAT amount. They also sometimes refer to that generally as the inclusive amount, right? So in our little example, that consideration would have been the 115 rands, right? We're going to come back to an example of that a little bit later. This might also be a list that Ms. Morris, or part of the list that Ms. Morris has made available. VAT input may be prohibited in certain instances. SARS provides a detailed list of those items that are not allowed to be, where we are not allowed to claim back the input tax. Generally, ladies and gentlemen, this is a general rule of thumb. Generally, it is items that either relate to entertainment expenses. So if you as a business owner, you take out your client to lunch, right? You take out your client to lunch, you are not allowed to claim back the input tax on that lunch expense because obviously that can be abused. I mean, if that was reclaimable, then that will I mean, most companies will then probably provide their workers with breakfast and lunch and everything because they can claim the value added tax back. So any entertainment expenses, and that actually includes staff refreshments. By the way, that On those, you are not allowed to claim back the value added tax, the input tax. Also, the purchase of certain motor vehicles. What do they mean by certain motor vehicles? I can't remember if your textbook actually specifies it, but let me tell you in any case, certain motor vehicles where you are not allowed to claim the value added tax back on are those vehicles that are deemed to be passenger vehicles. So maybe make a note of that, ladies and gents. So if it is deemed to be mostly a passenger vehicle, then you cannot claim back the value added tax. So for instance, if the business purchases a normal sedan, a normal kind of motor vehicle for the owner of the business, they are not allowed to claim back the value added tax. Now I'm going to ask you a little trick question. Doesn't matter if you've got this right or wrong. This is really just for fun. Just for fun. And this literally is the truth. You may not believe me, but you can go and read it up. If the business purchases a bucky, right, a pickup truck for the business, and it's got, what do they call those pickup trucks that's got four doors? I think they've got a specific name. Miss Morris can maybe help me, or any of you. What do they call them? The ones that's got a double cab. Thank you, Caleb. I couldn't get, I knew there was a name for it, but I couldn't remember what it was. If the business purchases a double cab or a twin cab, thank you, I would what? A twin cab or a double cab, right? In other words, it's got four doors, it's got seats at the front and seats at the back. Are they allowed to claim the value added tax back on that vehicle? Yes or no? Just guess. And you are all guessing correctly. Thank you. Thank you. You are quite right. They are not allowed to claim the value added tax back, the input tax on a double cab. Simply, ladies and gentlemen, it is regarded as mostly a passenger vehicle. Yes, Miss Morris.
Just a question for you. I know we had this, I think, when we were doing it. What about a hearse that transports dead bodies?
I haven't thought of that yet.
I can't remember. We
Hers
had
will
it in our tax
definitely no.
class before, but I can't remember whether or not that is
Yeah,
charged. But it
hers.
was one of those trick questions.
Yes, hers would definitely, in my opinion, and I used to be a VAT consultant many years ago. In my opinion, it would be you would be able to claim it back because I cannot two things. I cannot see first of all the dead body, the poor corpse, being regarded as a passenger. Okay, and clearly, you know, the larger part of that hearse is for the coffin to be transported in. And I doubt whether they even have a second row of seats. I'm not sure. But in my opinion, definitely a hearse, you would be able to claim the value added tax back, provided that business is registered for that purposes. Okay, so I'm 99% positive about that one. I cannot see that being deemed a passenger vehicle. And I'm sure even the revenue service will say no, the body is not a passenger. Okay. But ladies and gentlemen, just take this argument further. If the business buys a single cab or a single, what did we call it? Yeah, single cab. In other words, it's really a pickup truck. The major length of it is the pickup part. Can they then claim the input tax back? There, the answer is yes or no. A single cab pickup, Bucky, is actually regarded as not mostly a passenger vehicle. So if it's a single cab, the business is allowed to claim back the value added tax because they assume that that pickup is going to be used mostly to carry goods, to deliver goods to your customer, or to go and pick up goods from a supplier, or for some valid business reason. But when it's a twin cab, they regard it that it's mostly for passenger transport. and the passengers might have a few things on the back, but you know that you can even see that the back part where you can put where you can load all sorts of goods is probably not even as long as the coupe in the front. Okay, enough about that, ladies and gentlemen. That's just for interest sake. So now let's go to the second-hand goods, ladies and gentlemen. This when the Value Added Tax Act was written, it was actually published, and before it came into effect, the second-hand dealers uh, objected against the fact that they will never be allowed to claim input tax because they are buying their second-hand. Let's maybe take motor vehicles as an example. They are buying their second-hand motor vehicles from private citizens, right? They're buying them from you and me, and we as private citizens, we are not registered VAT vendors normally. So we cannot raise value added tax, which means there's no input tax for the second-hand car dealer. And the second-hand dealers said, whoa, whoa, whoa. This now is going to result in double taxation. We're not allowed to claim back any input tax, even though input tax was paid, or even though value added tax was paid by the consumer initially, but it is still expected of us to go and raise value added tax on the sale. And the revenue service agreed with him, and then after a debate of about a month or so, we the revenue service found a way to resolve the situation. So they created a special section of the Income Tax Act uh, that deals with notional input tax VAT. Notional input tax VAT. So, ladies and gentlemen, notional input tax VAT means the VAT hasn't actually been charged by a registered vendor to us as a business because we purchased it from a private citizen, but we are allowed to claim a so-called imaginary input tax credit. Let's put some figures to this. Ladies and gents, so let's say we are purchasing a second-hand vehicle as a business. So we're second-hand motor dealers, right? We're a business. We are purchasing it from a private citizen, let's say for 50,000 rands, right? We are purchasing it for 50,000 rands. When we are going to record this purchase, as we've said earlier, and later on we're going to do some examples, we've got to keep the amount of input tax, in this case notional input VAT, separate from the actual purchase transaction. So now our total consideration that we've paid is 50,000 rands. How much are we going to record, if you can type in the chat for me, as a notional input VAT? In other words, even though we didn't physically, really, truly pay it over to the private citizen, which is the supplier, we're still allowed to claim a notional or it's not really imaginary, but we're allowed to claim an input tax credit. How much are we allowed to claim as an input tax credit if we are going to pay 50,000 rands to that dealer, not dealer, excuse me, to that private citizen? I'm grabbing my own calculator here. Let's see if you can type in the meantime. Yes, I am speaking, or can't you hear me? This time I haven't switched off my microphone. But I did check. You had me worried there. No, I'm still sharing, ladies and gents, so you should still be seeing that. So my question there, oops, I wonder if I've got a network problem. It doesn't show a network problem. Okay, now it looks like you can hear me, so then many of you should. Maybe some of you just has a little bit of a network issue there. Oh, thank you. And let me pick. Okay, so you can see and hear me. Thank heavens for that. So what I was asking, ladies and gents, so if you're buying as a business, you're a second-hand dealer, and you are buying a motor vehicle from a private citizen for 50,000 rands, what is the amount that you will be legally able, to claim as input tax or input VAT? Who wants to try? Yes, how much? Or you can type a formula. It will be 15 over what? 15 over what? Of the 50,000 rands. Remember, you are paying the consideration. You are paying 50,000 rands. 15 over? Nope, nope. Keegan's got it right. 15 over. Thank you, Mercedes has got it right. 15 over 115, right? Because this, in the case of this notional input tax credit, they what you are paying, even though the supplier, which is a private citizen, they're not really raising the value added tax, you are allowed to claim the notional, in other words, as if that private person was a business. And then in Nati, you've got it right, 6,521 rands and 74 cents, right? So 15 over 115 multiplied by 50,000 rands, right? Keep that figure there. Hold that figure in your head. So 6,521.74, right? Now let's say we are able to sell this same vehicle. We, as a second-hand dealer, we are able to sell this vehicle for, let's say, 80,000 rands. That's a big profit, but let's say we are able to sell it for 80,000 rands. Now I want you to type for me there, what is the output tax that you are going to raise on it? What is the output tax that you are going to raise on it if you sell it for 80,000? 80,000. Correct, Angel. Now it's 15 over 100 times 15%. So that gives us how much? That gives us 15% or 15 over 100. Thank you very much. It gives us 12,000 rands. Now my last question for this little part. Our output tax is 12,000 rands, right? Our notional input tax is, what did we just say? If we just scroll up again, is 6,521 rands and 74 cents. If this had been, my question is, thank you, Pabalelo. My question is, if this had been the only transaction that we did, that we incurred during this 2 months VAT period, what is the amount that we as a business will have to pay over to the revenue service? You can type that for me. And someone, if you want to, you can also explain to me how you get that. What is the amount that you as a business will have to pay over to the revenue service? Asive's got it right. Right? Asive's got it right. Kukle, you've also got it right. Kutlwatu, you've also got it correct. Right? How do we calculate the amount that we have to pay over to the revenue service, ladies and gentlemen? It is our output tax, namely 12,000 rands, minus our notional or real input tax, which was 6,521 rands and 74. So when we complete our VAT 201 return at the end of the 2 months period, if that had been our only transaction, the amount that we have to pay over to the revenue service would be 5,478 rands. There we go. Thank you. Thank you, Mkisane. There you've got a formula for us. 12,000, in other words, the output tax, less that 6,000 odd, the input tax, that is the amount that you have to pay over as a business. Yes, Inati. Yes, Inati. Inati, you might be doing what I accidentally did a little bit earlier. Yes, pleasure, Sibisisu. So Inati, you must just unmute your microphone.
So his question is actually in the chat.
Oh. Inati, yes and no. I don't want to tell you that that's the general rule, even though it really is. What you have to bear in mind, your supplier, your supplier is going to charge you a figure that includes value added tax. In fact, when the Value Added Tax Act came into effect in 1991, you had the choice to give the price exclusive of VAT or inclusive of VAT. Now that caused a huge headache because some businesses displayed their prices exclusive, uh, in other words, excluding VAT. Other suppliers included the VAT. So you would go to Pick and Pay, and the amounts they display might be exclusive, and you add up with your calculator, and you add up in your head what is the amount I'll have to pay when I get to the cashier. And when you get to the cashier, you find you actually have to pay more because the tax wasn't included. And some other, just to make it more confusing, some other businesses, let's say Checkers, would have included the VAT. So after about 7 or 8 years that the VAT Act was in operation, the Act was slightly changed where they said all prices that you display as a selling price must include that, right? Must include that. So in Arti, what I want you to understand here, when you are going to get an invoice from your supplier, they must actually indicate what the amount of that is anyway. But the total amount of that invoice will be the consideration, right? So that will include the value added tax. So to calculate the input tax or the sorry, I'm used to the word input tax, so forgive me, it is the same as input VAT. Then you are going if you want to extract the amount of the value added tax, you're going to take 15 over 115, as you correctly say. But then when you are doing your output tax, the first thing, before you are even going to know, before you're even aware what your consideration is going to be, you are first going to determine your selling price. You remember from inventory that we did towards the end of last semester. So you first going to say, I want 100 rands from this transaction. And then you're going to say, okay, if I want 100 rands, how much must I add in terms of value added tax? And in that case, like you said there, you will have to take 15 over 100. Yes, exactly, Inati. So when you have inclusive of that, the so-called consideration, exactly as you say, and exactly as Vuyukazi and Miss Morris and Miss V, you are quoting Angel there. Thank you, Miss V. Exactly that. So if it's the inclusive amount and you want to extract the value added tax, it's 15 over 115. If it's an exclusive amount and you still have to add the tax to it, then it'll be 15 over 100. In other words, 15%. All happy with that? Let me just go there again. Yes, Miss Morris. Thank you, everyone. Yes, Miss Morris.
Okay, no, sir. I wanted to ask whether you're done with your notes. There's just something that I wanted to add.
Would you like to add it now or after the
Oh, no, I
slideshow?
can do it after you're done
Oh,
with your notes.
okay. Yes, there's actually another page of notes, but I'll only get round to that next week, I guess, because we've only got about 8 or 9 minutes left. So or even less. Sorry, students. So let us just finish this slideshow. Then that is done. Then we can carry on with the little page of notes next week, and we're also going to do some examples. Okay, so this really is something we've already discussed this, so this is going to be quick. I'm sure you'll be happy with that, Ms. Morris. We've already mentioned VAT is charged on the supply of goods or services. It's an indirect tax. It's important for us when we record it for accounting purposes that we must distinguish between the amount that belongs to us, which is the value, as well as the value added tax that is included in the amount, as well as the so-called consideration, because they're all going to go somewhere else, right? The value itself is going to be coming to us as a business, whereas the value added tax, the output tax part of it will be paid over to the revenue service. That belongs to them. And the consideration amount includes both of those. Right. And then as we'll see next week when we do an example, if your input tax for that period is more than your output tax, it means that the revenue service must refund you an amount. If your output tax is more than the input tax, it means you must pay in. Now, right at the beginning of the class, I mentioned that normally your output tax will exceed your input tax, because if it doesn't, then you are running at a loss. But do you think, you can just initially say yes or no, do you think there are circumstances where your input tax will exceed your output tax? There are two scenarios that I can think about immediately. Does anyone want to mention maybe one or two? Okay, I don't want to waste time. So one obvious scenario is where your business is that of an exporter, right? If you're an exporter, or the larger portion of your business is exporting, all your exports will be zero rated, whereas your input tax you can still claim back. So normally in the case of a business that is mostly exporting their goods, their input tax will be larger than their output tax, so they will get a refund from the revenue service. There's also one other scenario, and that is when it comes to the end of the year. Very often, when it comes to the end of the year, ladies and gentlemen, and we have the festive season about us, it's the December holidays. People get bonuses, and people buy Christmas presents for their family and friends and whatnot. Then very often those retailers like Pick and Pay and Edgar's and Checkers and whoever, they need to stock up more inventory than they usually have during the course of the year, because they're expecting a large increase in their sales during December. So they will already in October and November, unless it's fresh goods, obviously, but for presents, toys, and things like that, in October and November, they will already start stocking up on goods for the festive season. So you very often find that for five out of the six VAT periods in a year, they have to pay into SARS, but just that period before the festive season, they might have uh, uh, procured or ordered and purchased so many additional inventory for the festive season that they might get a refund in that particular period. Okay, and then just the last slide, ladies and gentlemen, we'll talk about that next week as well. I think this is the last one. We'll talk about that next week as well. When we deal with our financial statements, ladies and gentlemen, we've already said that it's not value-added tax is not uh, an expense to the company. So nowhere are you going to find it amongst a value-added tax expense in any statement. But what you will find, ladies and gentlemen, is at the end of your financial year, when you draw up your financial statements, if you owe an amount to the revenue service, right? If you owe an amount of value added tax, clearly that will be disclosed under which section of your statement of financial position. That the value added tax is a tax that you just the agent for it, right? You as a business, you just the agent for it. So you raise it from your customers, you pay to the suppliers, and the difference you pay over to the revenue service. So it's never an expense of yours. Correct, Kushle. Thank you. Correct, Asiwe. So if you owe money to the revenue service, you must pay it within a certain period of time. After the end of that period, it will fall under your current liability. So it can never be an expense for you. But if you still owe the money that doesn't actually belong to you, it belongs to SARS, but you haven't paid it to them yet, it will be a current liability. If they owe you in a specific period, if they owe you a refund in the next year, so this is your last period of the year. You've drawn up the financial statements and you see that your input tax exceeds your output tax, which means the revenue service owes you money. Under which section of the statement of financial position will that be? Thank you, Musanda. Thank you, Aneswa. Thank you, Asiwe. Under your current assets. Ladies and gentlemen, we're almost out of time, and I still need to give Ms. Morris a few minutes, so we're going to stop there. This is the end of the slideshow. Somebody asked whether it'll become available. Yes, but give me a little bit of time. I just want to add another slide in there. Right. I just want to add that little slide about the exempt income, but I will load it under that folder that I showed earlier. That's all from me. Thank you for attending, students. I appreciate that very much. Have a lovely rest of the day. I know it's not Friday yet, but have a lovely weekend, and we'll speak again next week, Thursday. Thank you. Bye.
Thank you, sir. Just a minute, students. Um, these notes and the whole section on VAT is important also for next year. So my advice to you is before next week's class, prepare, make your notes and keep your notes in a safe place, because when you are doing AIS 1A, you cover VAT again. And there it won't be explained to you the way it's being explained now. So please, it is important that you please just keep your notes and have the knowledge solid. Okay, thank you, sir.
Thank you very much, Miss Morris. We're actually quite on time. It's 5 minutes to 5 minutes to 1, so that is a good time to stop. Thank you, students. Thank you, Miss Morris, for holding my hand as well. I appreciate that. See you, students.
Yes, sir.
Bye.
Bye bye.